Is there a loan that would allow someone to qualify solely on their bank statements? And the answer is yes.
Yeah.
There are bank statement loans out there, right, where you can collect 12 months of someone's bank statements, and you are going to calculate the amount of deposits being made into the bank statement, into the bank. And then from there, we don't do these loans here at Waterstone. We broker them. It's called a non-QM loan, a non-qualified mortgage. Back in the day, we would have called that a subprime loan, right? That's really ugly, subprime. So we called it alternative A, right? Meaning your credit score would have had to have been deemed A rated, whether it was 680, 720, 740, but it's not going to meet any of the requirements of a qualified mortgage because we're not documenting your income. What we're doing is documenting how much money you have deposited into your bank account, and then from there we're calculating some form of a DTI based on those deposits. Yeah, and why is she doing that? Yeah, because her taxable income is minimal. There are ways of doing those types of loans, but at the same time, as a true professional, I would ask somebody, why do you think that? Would you mind sending me just last year's tax returns? I don't need 2 years right now. Send me your most recent tax return. Let me take a look at it. Right. I won a realtor relationship back in the day. This realtor, we ended up closing another 10 transactions with her over the next 4 years. I never once met her face to face because she lived in Point Siena. True story, not lying. And I was like, that's too far to drive. And it was her listing. Another lender absolutely screwed it up. This dude's like 740 credit score, 25% down. He owned 2 CC's Pizzas. Y'all know what CC's Pizza is? Yes. It's the best $6.99 you can ever spend on all you can eat pizza. I don't think it's real food. It's definitely like manufactured somewhere. It's like a mixture of like cardboard and fake cheese with tomato sauce, but it's just all you can eat. So it's fantastic. So this guy's like, I'm being denied like 5 or 7 days before. I'm like, well, yeah, hey, I'm probably gonna deny you too, but send me your documents. Super long story short, I look at him. The guy makes about 300 grand a year, but his taxable income was 65. True story. Like, he's writing off a ton. But he had about $70,000 in restaurant equipment depreciation. Well, I know, because I'm a well-versed mortgage professional who truly knows how to calculate income. Not, I know how to pull up a spreadsheet and go, box A, line 2, box B, line 7, and it spits out a number. I actually had an applicant reach out to me, and he was looking for a job as a processor. He's like, yeah, I've been a processor for 10 months. I said, oh, cool, let me talk to you about what you do for a living. Can you calculate income? Well, yeah, I can calculate income. I'm like, oh, walk me through how you do it. Asked him some simple questions. I'm like, this dude doesn't even know how to calculate his basic income. No, he knows how to pull information from a tax return and add it to a spreadsheet, but he has no idea of letting me know whether or not that spreadsheet is off or not. Right, because spreadsheets and computers are only as good as the human who's inputting that data. That's why each and every one of you needs to be trained how to do this job with a piece of paper, a calculator, and a pen. If you can't, that's your challenge. Because don't look at Encompass for your LTV. Don't look at Encompass for your DTI. Don't look at Encompass for your income. No, get out a piece of paper, get out a pen and a calculator, and you factor it, and then have Encompass let you know if you guys agree. If you don't agree, then you have to figure out who's right and who's wrong and why. So this particular person comes to me, and luckily I kind of know what I'm talking about when it comes to tax returns, and they had the $70,000 of restaurant equipment depreciation. I know it's a very easy thing. I can add depreciation back in. Well, he goes from making 65 grand to 135 grand. It's a big jump. That's doubling his income. He goes from being denied by another lender to pre-approved and closed in 14 days with us. And Anne-Marie Berkey ends up referring us 4 closings a year for about 10 years until she finally retired and moved down to South Florida. Never had to meet her once, face to face. She was the listing agent. Barbara Coy was the buyer's agent. And this guy owned 2 CC's Pizzas. And when I looked at his tax returns, I could see where he probably legitimately made about 200, 300 grand a year. Legit. But he was very liberal with his write-offs. But he did have restaurant equipment depreciation. That's a legit expense. Like here at Waterstone, I was just on a call with our CFO last week, and we have 85 employees. We're constantly buying computers. That's a big expense. Well, I know the accounting laws well enough that if the expense is under $5,000, I can't depreciate it. If the expense is over $5,000, I can. And by depreciating, what it does, it takes that expense of $5,000 and lets us spread it out over a 3, 5, or 7-year period. Well, if you're trying to make money for the company, do you want to hit the company's profit and loss statement one time for $5,000 today, or one time for $133 for the next 7 years? You want to depreciate it. Like that's what you want to do. That's how you show the most income. So depreciating of assets is a normal accounting practice. And it doesn't mean the company's not losing money. It just means that this guy at one point went out and spent $1 million on restaurant equipment, and he's writing it off slowly over time. That allows us to add that appreciation back in. What we do here at Waterstone, instead of buying one computer when we need one, because one computer is probably $1,800, we buy 10. We buy 10, we store them. That way, next time we need one, we drop it. It allows us to carry that cost over 7 years. I was able to add $70,000 back in as income, because it legit was income for the guy, and we qualified the loan. But that was me understanding tax returns better than obviously the lender over at the bank. So Alex, on your client, yes, there's bank statement loans. As Eric mentioned, there's also a debt service loan, basically another loan that allows us to qualify you solely based on proposed, I took it off the board, proposed rent compared to the estimated PITI, or take it one step further and ask them, well, what makes you think that? And they're like, oh, I just know. Okay, well, if you wouldn't mind, put me in contact with your CPA or send me your last year's personal and business tax return. And then if you get one and you're like, ooh, I can see there's an opportunity, then ask for the second one. And give them that option. Hey, eventually I'm gonna need two, but let's start with one. And if one is gonna work, then I ask you for two, but if you wanna send me both right now, I'd appreciate it. I need at least one, I prefer two. Let me take a look at it. The worst thing I'll say is, yep, we gotta go bank statement. Or what if you looked at it and said, oh, you own a daycare and you're depreciating $6,000 a month? More than likely it doesn't happen, because think about a daycare. What type of things do they have to depreciate? But whenever I'm talking to someone who's self-employed, knowing that about depreciation, I start thinking of what type of businesses have large ticket items that they depreciate over time. Contractors, construction companies, right? My buddy owns a company that does site development. They go out and clear land. Think of how many like dump trucks and excavators and bobcats that they have. That stuff's expensive. So he may have $2 or $3 million worth of equipment that he depreciates $100,000 a month. So his taxes may only show him making $65,000 a year, but he probably actually makes closer to about $165,000 a year once I start adding back in depreciation. And you all can take classes on calculating income at the most basic level, and then you can take self-employed, and then you can take self-employed like the 4,000 level. And the stuff that we're talking about is knowing self-employed is 4,000 level, right? Knowing that I can add back in mileage when it's written off. I can add back in some of it through a depreciation add back. I can look at someone's depreciation, whether it's restaurant equipment or whether it's machinery. I can add that back in as income. But if it's meals and entertainment, I have to double it. So whatever the tax return shows, I actually technically have to double it. That's going to reduce their income. If I have a client who's very liberal with their what they claim to give to the Salvation Army and AMVETS or their church in cash, good news is we don't have to count that against them, right? So that money doesn't hurt them.